This is Alan Bush with the Daily Financial Forecast for Tuesday, February 2nd. In the stock index futures, we are seeing some sharp declines today. This primarily due to energy prices that have come under quite a bit of pressure, with the crude oil down about $1.50 so far. Also, we did see the Chinese stock market trading higher, but that was the relationship from earlier this month where U.S. equities would trade in tandem with Chinese equities. So that's not so much the case now as traders center on the energy markets. Also, we did have one report that did come in weaker than expected. That is the New York Institute for Supply Management Index coming in on the weaker side, so that adding to some of the pressure. One positive note, though, is earnings overall are looking a little bit better than what had been previously predicted. Even though earnings are down from the previous quarter, the numbers seem to be coming in better than what was anticipated earlier. Also, once the energy influence is mitigated, or another way of putting it, once the energy markets stabilize, that will leave us with the low interest rate environment globally, and that will be supportive to stock indices. Now, moving over to the currencies, seeing the euro currency trading higher. This after Eurozone unemployment falling to a 4-year low, with the Eurozone unemployment rate now at 10.4%, down from previous month's 10.5%. Also, the German unemployment rate falling to a record low. In fact, a record low since German reunification. So that's supporting the currency of the Eurozone. The pound a little bit weaker on ideas that the Bank of England will not be able to raise interest rates anytime soon. Also, we are seeing a little recovery in the yen after that very severe decline that we saw on Friday when it was announced that the Bank of Japan was moving to a negative interest rate policy. And the commodity currencies, the Canadian dollar and the Australian dollar, as you would expect, lower in conjunction with the energy markets that are under, again, pressure today. Over in the dollar index, though, we do feel that the dollar will be supported longer term, since the Fed is the only major central bank that is on course to raise interest rates possibly this year, although the probability of a rate increase now just a little bit over 50% for an increase in the Fed funds rate at the December meeting. So the dollar should stabilize and work higher, and I would also look for new highs for the move in the dollar index later this year. Now, moving over to the interest rate futures markets, higher prices at the long end. This due to weaker stock indices and lower energy prices. Also, we do have some new highs for the move. Some of the strength can be linked to the negative interest rate environment that we are seeing in parts of Europe, and of course now in Japan with their latest policy move. So investors fleeing areas that have low interest rate structures and are moving into U.S. Treasuries, which still have a positive yield. So once again, probability of a rate increase at the December meeting at 54%, creeping up from 53% yesterday. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.